Okay, here we go. All right. Well, the title of the session was Sources and Remedies of Financial Market Instability. I'm going to give you a perspective from the point of view of Hyman Minsky. So let's see. Am I advancing here? Is this correct? Let's see. Pardon? Thank you. Okay, wrong machine. Okay. So first of all, a bit of a primer on Minsky. But it's worth pointing out he's somebody who was first ignored by neoclassical economists, and I can give no better example of how he was ignored than the man who's supposed to be the expert on the Great Depression, which is why he got the job as Federal Reserve Governor, Ben Bernanke. This is the entire consideration of Minsky in Ben Bernanke's essays on the Great Depression. He said Minsky argued for the inherent instability of the system, but had to depart from the assumption of rational behaviour. And he didn't deny the importance of irrationality, but thought the important research trajectory is to push the rationality postulate as far as it would go. End of story of Minsky in the person who's supposed to be on the expert. As I argue in Debunking Economics, he's not an expert on the Great Depression, he's an expert on neoclassical explanations of the Great Depression, a very different thing. Now Minsky's been taken seriously, but again I'd say they're being misinterpreted. So if you look at Krugman and Eggleston's paper from 2010, early 2011, the Fisher-Minsky coup approach to financial market volatility, it's an equilibrium DSGE model. It doesn't have endogenous money or banks, and aggregate debt does not matter. It's only the distribution between patient and impatient agents that matters in that model. Now, if you look at Minsky's own opinion of whether he could be modelled using neoclassical foundations, he rejected the neoclassical paradigm. And this is how he put it. He said the abstract model cannot generate instability. In other words, leave out the epicycles of the new Keynesian model and just take the fundamental paradigm of stability, equilibrium, and so on. You can't get cycles out of that system. It converges on equilibrium. And he said when you construct that synthesis, capital assets, banks and money, liabilities, and knowledge about uncertain futures all disappear. And to do better, we have to reject the synthesis. So he wasn't particularly sure that he could be modelled using a neoclassical foundation, but maybe he was wrong. You never know. Could it have been done? Well, looking at another perspective, no, it couldn't have been, because some essential aspects of how Minsky thought come from Fisher and Schumpeter, and that focus upon disequilibrium. Not just a slight divergence from equilibrium, but a tendency never to reach equilibrium. If you are there, it becomes destabilising. And Fisher put it best when he recanted his neoclassical position after the Great Depression and said that even if you assume all variables tend towards equilibrium, in the real world, those variables will be disturbed. So they'll be either above or below equilibrium, even if you assume that is the direction in which it's heading. And he said it's as absurd to assume the system is actually in equilibrium as it is to assume that the Atlantic Ocean can never be without a wave. And Minsky equally arguing the same thing, so that stable growth is inconsistent with a debt-financed economy, because when you have stability, a period of tranquility will lead to people forgetting the previous crisis, becoming more optimistic, going to what he called the euphoric economy stage, and moving away from the equilibrium. So in Minsky's vision, equilibrium itself is destabilising. And an important difference between Minsky and other critics of financial capitalism is that whereas a lot of the Marxist critiques argue about underconsumption and so on, Minsky's point was the fundamental instability of capitalism is upward. The tendency to transform doing well into a speculative investment boom is to Minsky the basic instability of a capitalist economy. Now this also raises the issue of endogenous money. And Minsky was certainly not the first person to argue this position, but it's an essential part of his theory, coming back from as far back as Schumpeter and even further than that, back with Marx. And Schumpeter, in this particular passage, was considering how does one finance investment. A conventional explanation is that you invest by saving. And he starts off by saying, well, the conventional answer is not obviously absurd, but there's another method of getting money, and that's the creation of purchasing power by the banks. And he said that's not transforming already existing purchasing power. It's not taking money from savers and giving it to borrowers, not taking it from patient agents and giving it to impatient agents, but it's the creation of new purchasing power out of nothing. Now, that's a phrase you'd often associate with a crank. Schumpeter was no crank. Now, ironically, you'll often find that neoclassical economists, when they do good empirical work, actually confirm some of the arguments of non-neoclassical economists. And here's a classic instance of Fama in French, looking at corporate data over about a 40 to 50 year period with a very detailed database of American corporations and saying, what is the determining factor in the level of investment? And what they found was the determining factor was the change in long-term debt. And looking at it, they said that debt plays the key role in accommodating year-to-year variations in purchasing power, and they put it much better in a draft version of the paper where they said debt seems to be the residual variable in financial decisions. Investment increases debt, and higher earnings tend to reduce it. So debt and rising debt, changing levels of debt, play a fundamental role in driving investment in a capitalist economy. But not only investment. And of course, I know this is a point which some of our absent friends don't particularly follow. You may have noticed I had a little contretemps with Paul Krugman last week and the last couple of weeks. And one question he asked there is, well, I'm all for including the banking sector where it's relevant, but why is it so crucial to a story about debt and leverage? Yeah, well, let's ask the central banks. This is a brilliant paper from the then senior vice president of the New York Fed, Alan Holmes, writing back in 1969, fighting what is then ultimately a failed campaign to stop monetarism being done on sheer technical grounds of whether it could actually work given the mechanics of money management in America. And he said monetarism, and therefore in general the neoclassical model of money, makes the naive assumption that the banking system only expands loans after the system or market factors have put reserves into the banking system. Now, the next sentence is crucial. We couldn't say it more concisely and more powerfully. In the real world, banks extend credit, creating deposits in the process, and they look for the reserves later. And even if you think you can control them using that reserve system, the reserves themselves at that stage were set on the deposits for the 2 weeks prior to the week you had to check the reserves. It's now about 1 month. The banks have actually extended that time lag. And therefore excess reserves have to be available in the banking system and are in fact available courtesy of the redistribution of that loaned money through the system. They can be borrowed from other banks or taken, if necessary, from the discount window, but the money simply has to be there. So the causal system, according to a technician who knew his stuff, was the reverse of the causal mechanism of the money multiplier. But you can go further again. Now, looking at the statements I'm taking here, I'd like you to guess the intellectual allegiance of the authors behind this paper. And doing an empirical study, looking at the leads and lags in the American economy over about, again, a 40-year period using statistics of the economy, the aggregate statistics, they said there is no evidence that the monetary base leads the cycle, which again would be an essential part of the conventional argument of how money is created. In fact, the difference between M2 and M1, which is pure credit money, leads the cycle by about 3/4. So credit money precedes changes in base money. And they said, therefore, credit arrangements should play a significant role in future business cycle theory. And introducing money and credit in this meaningful way to account for cyclical behaviour of real as well as monetary aggregates is an important open question in economics. Of all people, that was Kydland and Prescott, people who gave us real business cycle theory. They did not follow their own advice. So there's plenty of research out there to establish that it's not banking mystics who think banks can create money out of nothing and therefore make the system different, but we don't really understand what's going on. It's barter mystics who believe you can model capitalism without banks, money and credit. We have to include it there. Now, an essential part of this, I normally do mathematical modelling of Minsky here, but what I'm going to go into instead is looking to the arguments you can get out of Minsky about the role of changing levels of aggregate private debt in the economy. And an essential part of Minsky here was the proposition that growing aggregate private debt is the source of economic growth. Because he said if you're going to have incomes growing over time, then demand has to be growing. And for that to happen, current spending has to be greater than that, which could be financed out of current income alone. He said it therefore follows that some agents in the system have to be financing their expenditure by borrowing money or by selling assets. So rising debt is an essential part of a capitalist economy and not one that has to be criticised. It's actually plays an essential role when it finances investment. But it also finances Ponzi schemes. And this is where we get into the trouble we are now. And of course, a Ponzi scheme involves an agent who is losing money, fundamentally losing money, and therefore has to either sell assets for a higher price than they were purchased for, or borrow money before they can sell the asset. They have an insatiable demand for money, and therefore they're an essential part of the expansion of the money supply during a boom like the one we went through that people thought was a great moderation. Now that debt in turn drives up asset prices. And Minsky again argues when you have a period of tranquil growth, that reduces the concern people have about the future. They want to hold money less and hold income-earning assets more, or speculative assets more, leading to a rise in the price of capital assets and therefore more Ponzi finance accepted by bankers, and therefore the financial system endogenously generates at least part of the finance that's needed to sustain that Ponzi behaviour and push the asset prices up. So to bring this to a monetary perspective, there are two sources of monetary demand in a capitalist economy. The first, neoclassical economists and myself agree upon, incomes, which collapse effectively to wages and profits, but the part that they cancel out by saying borrowing is just transferring from a saver to a borrower and therefore has no aggregate impact, with endogenous money, borrowing and the change in debt is an additional source of income. Just like it is for you, if you go shopping, you can either buy out of your income or put it on the credit card. That aggregates. It does not get cancelled out. So at the national level as well, aggregate demand is income plus the change in debt. Now again, we've separated the asset markets from the physical markets with neoclassical theory, clearly getting that wrong. Of course, monetary demand is spent on two particular targets: goods and services, basically the macroeconomy, but also net new financial assets, expanding the valuation we put on existing financial assets. And Schumpeter put this down quite nicely. He said income is largely spent on consumption. The change in debt mainly gives you the funds for investment, and Minsky added to that, it also finances Ponzi behaviour. So you can put that together in an equation to argue that wages plus profits, which are basically income, plus the change in debt, is then balanced by spending on consumption, investment, and net growth of the financial sector, the FIRE sector. So wages and profits get transferred mainly to consumption. The change in debt mainly finances investment, but also activity in the FIRE sector. And I call this Walras Schumpeter-Minsky Law. To give Walras his credit, he was trying to get a sense of aggregate balance, but he left the financial system out of it. When you include it, you've got to go beyond simply Walras' law, and that is that aggregate demand is income plus the change in debt, and aggregate supply is goods and services plus the net turnover in the financial markets. So again, putting that in equations, you look at income plus the change in debt being equivalent to GDP plus net transactions in the financial sector, and you can break that down into the impact that change in debt has on the level of employment and output, and also the impact that change in debt has on asset prices. Because on that equation you have a relationship between the change in debt and the level of asset prices, but if you look at the change in aggregate demand, you get a relationship between the acceleration of debt and the change in asset prices. And therefore, to have sustained growth in asset prices, you have to have accelerating debt. Now, I can put an empirical leg to this argument. It also can explain why asset prices have to bust. Because they're dependent upon forever accelerating debt, they simply have to stop. Not even debt can accelerate forever. So to give you an overview of aggregate debt, this hasn't turned up except for Dirk Bessemer's presentation earlier today. This is looking at the ratio of private debt to GDP and public debt to GDP in America over the last 90 years. And I'm sure casual empiricists will tell you the only time like the time we're in now, where there's been a high peak in debt and declining, is the Great Depression. Only the Great Depression compares to now. And only the Roaring '20s compares to what we call the Great Moderation, because during that period you had rising debt, and during the Depression, falling debt. And by the looks of that graph alone, you can see we've got a long way to go before this crisis is over. Now, to give you an overview of aggregate debt as well, breaking it down in sectors, not looking at borrowers versus savers now, but looking at the distribution of debt between different sectors, there is a major difference. The business sector, the non-financial business sector, was in much more debt back in the Great Depression than now. Households are in much more debt now than back in the Great Depression. And of course, the finance sector is astronomically more indebted. than it was back in the Great Depression. And the dynamics of this debt can explain both the Great Depression and the crisis we're in now. So looking at the relationship here between aggregate demand and between GDP and change in debt, adding the two together, the red line is GDP alone. The black line is GDP plus change in both private and public debt. The blue line is private debt alone. You can see the slump beginning when they had the plunge in the level of rate of change of debt, so that rather than adding to demand, the change in debt was subtracting from demand. Now keep that visual picture in mind. This, again, just to repeat it, that's the situation of the Great Depression. See how relatively, well, the gap is there between GDP and GDP plus change in debt. This is today. A far larger gap and a far larger plunge to begin with, then bouncing around with a much more rapid acceleration of debt after the change. Now looking now at the acceleration of debt and the level of economic performance, here's the acceleration of debt correlated to changes in employment back in the Great Depression with a correlation coefficient of 0.76 using annual data. Again, that's the picture for the Great Depression. This is the picture for now. So the acceleration in debt is driving the change in employment. Correlation coefficient this time over 30 years, 0.69. Share prices. Now, to me, it's almost bizarre that this actually works because we know how volatile the stock market is. We know how much panic drives what happens there as well as the cash flow. This is the Dow Jones deflated by the Consumer Price Index over the last 90 years or so. And the blue line is the average, the black is the trend between 1915 and 1995. And there should be a trend to share prices because of retained earnings and companies like Berkshire Hathaway and so on. So taking out that trend, this is the deviation from trend over time. Now it's fairly obvious the deviation we went through in 2000 was the biggest in history, bigger than the Great Depression, bigger than the 1966 bubble, which Minsky took as the point of transition from a robust American economy to a fragile economy. And we didn't quite get back to that non-deviation even when the Dow fell down to, what, 6666, whatever it reached some time ago. Now looking at the relationship between the acceleration in debt and that deviation from the long-term trend. This is back in the 1920s, correlation 0.65. Over a 20-year period, both the boom of the 1920s and the bust of the 1930s. Correlation now, working with monthly data, 0.65. By the way, back then, pardon me, now 0.34. Take a look at how deep the plunge in debt was, the rate of deceleration of debt that began the crash. And that's the biggest deceleration of debt in America's history, including the Great Depression. House prices are a much more effective one because with house prices I can isolate it to mortgage debt and look at the acceleration of mortgage debt and correlate that to the change in house prices. Now, over the long term, using the Case-Shiller data, there is no trend. With the index starting at 100 in 1890, the average for that whole period was 98. Now, notice where Greenspan is marked on that chart. That's when Greenspan spoke to Congress and said there was no bubble. Okay? And if it did burst, it wouldn't cause much of a macroeconomic mess. It shows us how untrustworthy that neoclassical perspective on asset markets and finance truly is. Now looking at the relationship between the acceleration of mortgage debt and the change in house prices from 1986 to today, again you can see the deep plunge and deceleration of mortgage debt. The correlation there is 0.78. So the change in debt is what's driven us into a depression. It's what gave us the false boom beforehand. So sources and remedies. Well, since accelerating debt is the source of asset bubbles, the only way you're going to stop them is by breaking that link between accelerating debt and rising asset prices. You have to find some way of making debt unattractive because banks are never going to find lending unattractive. We have to make it unattractive for the public to accept that debt. So I have two modest proposals. Thank you, Yannis, for a wonderful word. The first is Jubilee shares. And the idea is that shares, if you bought them off an initial public offering or from the company, would last forever just as they do now. Absolutely no change. And you could trade them 7 times on the secondary market. I'm using biblical numbers here. and after the 7th trade, the share would last 50 years and then expire. Now, the idea behind this, which I adapted from my friend Troy Andreessen's systems engineering arguments, is that you'd be a true fool, not just a greater fool, but a greater blithering idiot, to borrow money and gamble on rising asset prices, buying a share which is going to expire completely in 50 years. So it would hopefully make the primary market far more important, the secondary market less so. The second proposal relates to the other great asset market, property, and I call that the PIL, which stands for Property Income Limited Leverage. Now, at the moment, supposedly houses, when you go to borrow money to buy a house, it's based on your income, which gives you, competing with somebody else, an interest in getting a higher level of leverage out of the bank. But the idea of the PIL would be to limit the maximum mortgage you could secure against a property to something like, say, 10 times the annual rental income of the property, actual or imputed. And therefore, to beat somebody else, you'd have to offer a larger amount of saved money. There'd be a negative relationship between house prices and leverage rather than the positive one now. That's the whole idea, to break down that desire to get into more debt. And that would leave debt just for the beneficial investments we need it for, rather than for speculation. And just one more thing, one thing I'm also arguing, we've got to go out of the crisis now. I'm arguing in favour of what I call a modern debt jubilee, or what you can call more, well, not colloquially, but it makes sense today, quantitative easing for the public. Rather than giving Federal Reserve money to the banks and saying, please lend, as if what America needs is more debt, give it to the public and say, you must cancel your debt. If you're in debt, you've got to use this injection to pay your debt down. If you're not in debt, you get a cash injection. So you necessarily reduce banks' debt, you necessarily reduce the value of the financial sector and its income, but you don't penalise people who've been savers or who've bought toxic assets off the banks, because they get a cash injection instead, which minimises the damage to aggregate demand, which is what we have to restore. Thank you.